We are starting with the topic factors affecting financing decisions and capital structure. So there are various factors which affect the financing decision, or you can say the capital structure of a company. The first factor is cost. Fine. Generally, what is considered that a good financing decision is a decision which where the cost of raising finance is minimum. Fine. So a financing decision which provides the cost of raising finance, a minimum cost of raising finance, that particular decision is considered to be better or good. Fine. So the cost is a very, very important factor while making a financing decision. Cost of debt, right? Cost of debt which is given to the lenders, that is the interest, right? Whenever we raise fund through debt fund, or you can say the borrowed fund, right, we pay interest to the lenders. Fine. And the cost of equity, that is dividend, right, which we generally pay to the shareholders. Fine. So cost of debt which we pay to the lenders is the interest, and cost of equity is the dividend which we pay to the shareholders. So there is a cost involved in raising funds through various sources. If the rate of interest which we pay to the lenders, right, if that rate is low, fine, so we have a possibility of raising more debt funds. Fine, because rate is low and we can raise more fund through the debt, or through the borrowed fund we can raise more borrowed funds. Fine. Then debt fund, they are considered cheaper. Why they are considered cheaper? They are considered cheaper because they are tax deductible, right? They are tax deductible. So if we are raising fund through borrowed fund, or if we are raising debt fund, that depends on two major factors, that is the rate of interest and the tax deduction. Fine. So we raise fund through borrowed fund because of lower rate of interest, and it is a tax deductible source, right? Now if a company, cannot raise debt fund, or a company cannot raise finance through borrowed fund because of a reason that it cannot be, we cannot raise fund through debt or the borrowed fund because of this reason, that if we increase the debt portion, in a capital structure, what is capital structure actually? That I have told you. Capital structure is the proportion or the ratio in which we raise fund through borrowed or the equity fund. So that is the proportion, that is the ratio in which we raise fund through both the sources, right? So if we raise fund, if increases the debt portion, then that eventually increases the financial risk. Financial risk is what? Financial risk is the commitment of paying back the principal amount and the interest, right? So if debt portion increases, the financial risk increases. If financial risk increases, then the liability on the company to earn more profit, fine, that also increases. Fine. Because if we have to pay interest or the principal amount to the lenders, then we have to have money in our hand, right? There should be cash inflow. Fine. So the need of increasing more profit increases, right? So that's why a company cannot raise fund through borrowed fund or the debt fund beyond a certain limit, because ultimately what will happen, that will increase the risk, financial or the risk portion of the company, right? Second point is the risk. Second is the risk, how risk affects financing decision. Debt, as I told you, that we can raise fund through two different sources, that is borrowed fund and the shareholders fund or the equity fund, right? So generally debt fund, they are considered as cheaper. Why cheaper? Because of they are the tax deductible, right? And they are more risky. Why they are more risky? They are more risky because of this factor that we have to pay the principal amount and the interest amount to the lenders, right? There is a level of commitment, a high level of commitment of paying back the principal amount and the interest. Fine. So that's why debt fund, they are considered as cheaper, but at the same time they are considered as risky. Fine. So if more debt fund is used, the financial risk increases. Fine. You know, if a company is raising fund through debt fund or through the shareholders fund or the equity fund, then we have, you know, one more factor is considered. One more factor is considered that, you know, a company is a business is run generally in a there is a business environment in which a company or a business run, right? So they have to see that what is the level of risk in the business environment, because a business environment is risky. Why it is risky? You know, so we have to look at the level of risk attached to the business. If a business is already having a lot of risk involved in terms of suppliers, in terms of competitors, in terms of product, right, in terms of sales, in terms of growth, so they have to see, you know, is there any possibility, is there any scope of raising or, you know, having or taking more risk. Fine. So if a company can afford to take more risk, fine, then only they will increase their debt portion, otherwise they will not. Fine. Third one is the floating cost. What is the floating cost? Floating cost is the cost generally, the cost which is incurred in raising fund. If there is a high floating cost, then that particular source of finance is considered as less attractive, right? That is considered as less attractive. For example, if we are raising fund through a shareholders fund, or we are issuing shares and all, in which you will see that there is a high floating cost. Fine, there is an application form, you know, in that we expenses are incurred, right? But if we are raising fund through debt fund, then, you know, we don't have to pay anything for raising fund through debt fund. Fine. So that's why raising fund through the borrowed fund, that is considered as cheaper than, you know, raising fund through the shareholders fund. Fine. Now comes the fourth point. The fourth point is the cash flow position. When a company decides the source of finance, then they consider their cash flow position, that what is the cash flow position of the company. If a company is having a strong cash flow position, or right, then, you know, a strong cash flow position ensures or confirms confirms paying back the debt, right? It confirms the ability to paying back the debt, right? If we are raising fund through the borrowed fund or the debt fund, then and the company's cash flow position or the financial position is strong, then there is a surety, there is a conformity that company will be able to pay the interest amount and the the principal amount to the, they will not think twice before, you know, giving money to the company. Fine. But if company doesn't have a strong financial position or a cash flow position, then such company cannot go for raising fund through debt fund, because there is no surety of paying back the profits. Fine. Now the fifth one is level of fixed operating cost. Now what is the fixed operating cost? Operating cost is related to the cost which incurred in the day-to-day business. Fine. So fixed operating costs are the costs which are not affected by the increase and decrease in the production. If there is no production taking place, then also such costs will incur. For example, rent, salaries. Fine. So such cost will be there if there is any production taking place or not. Fine. So before raising fund, right, or before making any financing decision, a company has to see that what is the level of their fixed operating cost. If they have high fixed operating cost in their company, so they cannot, go for, or they cannot afford raising fund through debt fund or the borrowed fund, right? Because why they cannot afford? Because there is a, debt fund. If a debt fund requires a commitment of paying back the interest amount and the principal amount, right? Whereas if a company is having a low fixed operating cost level, then they can raise fund through debt fund because they don't have fixed operating costs. So there is again a conformity that they'll be able to pay back the profit, or you can say they can pay back the interest and the interest and the principal amount to the lenders, and they will be able to provide right, if they'll be able to provide a dividend to their shareholders. Fine. Let's come to the next topic, next factor, that is tax rate. So how tax rate is going to affect the financing decision or capital structure? As I told you, that cost of debt is interest and interest is tax deductible. So the tax rate basically decides that which particular source of finance we have to choose, or which source of finance has to be chosen, right? If there are prevailing higher tax rate, then a company will definitely go for the debt fund or raising fund through debt fund. Why? Because debt is considered as cheaper, right? It is explained through an example, with the help of an example. For example, we have a company has borrowed 10 lakh rupees, fine, and they have to pay 10% interest on that, fine, and the tax rate which is prevailing in the market is 30%, fine. So effectively the tax rate, the effective tax rate is, the calculation is 10% is the interest, fine, which company has to pay as a cost of debt, or you can say the interest rate is 10%, and 30% is the tax rate, right? So 10 into 30%, that is 3%, fine. 10% minus 3%, that is 7%. So you will see that ideally a company is paying 70,000, right, instead of paying 1 lakh as interest, fine. So higher the tax rate means the debt fund or raising finance through debt fund is preferred, fine. Next, then come to the next point or the factor, that is control consideration. A management control consideration means the level of control shareholders or the owners they have in the business or on the business, fine. So management control over business. If a company prefers or decides to raise fund through equity or by issuing shares, then there is a chance that the management control can be diluted, fine, or the percentage of holding which management has over the business, that will decrease, fine. So issuing shares or raising fund through shareholders fund, that dilutes the management control. So that is not, raising fund through shareholders fund, that is less preferred, whereas management control over business, that is not affected by debt funds, because we are not giving any share, right? We are not giving any share to the lenders in the company. We are only liable to pay the interest amount and the principal amount to the lenders. Whereas if we are raising fund through issuing shares, right, then we have to give a portion, right, a portion or share to the shareholders in our company or the holding in our company, fine. Then the 8th point, that is stock market position. Before raising fund or before deciding upon the source of finance through which the finance or the fund has to be raised, a company has to look at the stock market position. If stock market position is at boom, then they will be able to raise fund through issuing shares, and if stock market is depressed, then the company will go for issuing or raising fund through debt funds. Fine. Next point is regulatory framework. Regulatory framework